Are you depending on one account for retirement? Social Security? Savings account? You think Social Security is enough? You need a 3-pillar plan. And I'll break it down that right now. I'm Dakota Grady, DG the Money Coach, and I'm all about helping you to master your finances. Let's dive into the conversation. Are you afraid that you're going to run out of money in retirement? Drop in the chat below. Last video, I mentioned that you need a 3-pillar approach to investing. Because some people are dependent on Social Security and a savings account for retirement. I recommend a 3-pillar plan because you need a stool. Think about a stool, right? A table. What if a stool had one leg on it? That one leg could be just 401k. What if that 401k it gets dissolved? You put all your money in a company and it gets taken out. Say Enron, for example. You invest in your company, put all your eggs in one basket, and it gets dissolved, goes away, right? Wrong answer. Or maybe it's depending on Social Security. Social insecurity, that is. What if it's all this thing? Some people don't think it's going to be there for certain generations because the boomers are going to retire and take all the money out, right? So you need a 3-pillar approach to investing. The first one is a Roth IRA. That's one of my favorites because this money grows tax-free. When you put money into it, you've already paid taxes on it. And when you take the money out, it's not taxed. That's a sweet deal the IRS offers you. Now you can invest up to, for this year, $7,000 and have a catch-up if you're 50 years older, an additional $1,000. So you have a total of $8,000 that you can invest. Now, if you have a spouse, he or she doesn't work, you can also have a Roth IRA as well. So you could potentially have up to, $14,000 or $16,000, depending on your situation, to invest in your Roth IRA. Now, for me, I had a Roth, but originally I had a 401k at my job. When I left my job, I took my money out of the account, rolled it over into a Roth, paid taxes on it, and my account has been a Roth for years, so it's growing without tax implications, right? So when I retire, I'll take the money out without paying taxes on it, y'all. Sweet deal that you need to do as well. The second thing is, if your employer offers an account such as 401k, a 403b, or a 457 plan, take advantage of it. Those are plans that are also qualified plans, meaning the IRS gives them special tax treatment when it comes to investing. So with those plans, you invest with pre-tax dollars. That means the money you put into it is not taxed. You only pay tax on that money when you take the money out of the account, whether it be early withdrawal or when you reach age 59 and a half or older, that money will be taxed at the time. But the whole point is invest in it. Some companies may offer a match. I mean, they may match up to 3% of your income, right? Or they may match up to your contribution. It depends. But the whole point is I want you to invest, take advantage of the match, because they're giving you free money. The IRS is too, because they give you money to, you can invest up to $7,000. Again, they have similar rules as their Roth. Again, the IRS is allowing the company, employer, to offer the match to you. So it's free money. Take advantage of it, because why not take advantage of it? They're giving you money on top of money. And the third thing is a taxable account. A taxable account is basically a brokerage account with a Schwab or either a Fidelity. You can create those accounts and they're taxable. So basically, if you get a mutual fund, which is a group of stocks for different companies, all in one pool, or they pool the money together to invest in these companies. Investors, they want to buy some stocks and they want to get a big fund, and they go and put the money into the pool, and the fund manager manages the pool. So the value of the fund goes up when the value goes up. So that's what a mutual fund is. People mutually invest their money into a pool of stocks, and the fund manager manages that pool. So even though it's a mutual fund, say you invest money and you get dividend, which is basically earnings on your investment. Well, even though you may be reinvesting, you get a dividend, you earned it, and you put it back into the pool to buy more shares, you'll pay tax on that investment because you're getting it earnings and you'll pay tax on the earnings. Even though you're not taking it out, actively taking it out, it's still taxable income to you. And then you'll pay tax on that money every year if you're selling stocks in your portfolio and the value goes up, that money is taxable to you. So even though it's taxable to you, it is an option for you to really grow your wealth. But I want to be specific on when you get a brokerage account. Be ready to pay taxes on your money, because even if you get a mutual fund, every year you'll pay taxes. So if you got a job, set some money aside for taxes to pay on your earnings from your retirement account. So I hope this is helpful to you. This is the plan that I recommend doing for y'all. Get your Roth IRA, hands down. If nothing else, get a Roth. Secondly, invest in your 401k or your employer. And third, if you can, get a third option. I recommend getting a mutual fund with a brokerage account, and be prepared to pay taxes on that money when you do get earnings. I hope this was valuable to you. Please like, share, comment, and subscribe to the channel. And keep watching the next video to get value on how to grow your retirement and how to handle your finances.